started this morning. Thank you for attending on this chilly day. First order of business is to approve the minutes of the meeting for October the 8th. Moving to second. You're for it? Aye. Aye. Any opposed? None. Hearing none. Okay. Second item is Roman numeral number 3, report on judgments for the month. I believe you have that in your packet. Okay. Second. For it, say aye. Aye. Any opposed, same sign. Hearing none. Roman numeral number 4, ratify approvals. Let's do these one at a time because there's going to be some discussion perhaps on one of them. So look at the first one, payroll for the month of October.
Got it. Second.
Okay, it's moved in second. For it, say aye.
Aye.
Okay, any opposed? No. Hearing none. Let's skip to number C, where the action of the Secretary Administrator. What's your? Second. We're going to move in a second. You're for it, say aye.
Aye.
Any opposed? Say nay. Okay, Renee. Oh no, Wally's back here. I'm sorry, I didn't see him come in. Wally, you want to come forth and talk about item B for us, please?
Well, this is one of the first cases that's come forward since the trustees made an election to retain a couple of law firms that specialize in class action litigation involving pension funds. And this is one of the first cases to come forward. And because by the time we got notice of when they had to file an appearance and answer, we had to make an executive decision to go ahead and do it. And so we're asking you to ratify the actions of WB and Renee in retaining the Eisenhower firm to represent you all in this class action lawsuit as a co-plaintiff. And this firm will handle it from that point forward. One of the advantages is that if we go in as co-plaintiff, and we may not do it on every case, but when we have a substantial investment, as we do in this case, we have a better control over what the settlement will be, or at least some control. Other than that, we're just at the mercy of whatever happens. So when the investment's big enough, we'll probably bring you an opportunity to go in as a co-plaintiff. Hopefully, we'll have an opportunity to do it before we had to make the deadline. But in this case, we had to go ahead and do it in order to get it.
That's the only question that I have. Is this the nature of these, that the timing of it often will, because we're only meeting once a month, that the timing could be where we have a situation like this?
Hopefully not, but yeah, I mean, because lawsuits move pretty quickly and we don't always get notice from the law firms in time to have a meeting.
And if we do that, is there a process that we should have in place where, even though that Renee and WB need to be able to act, is there a process or something that we should do to provide for that as opposed to just ratification, or if there's some notice that should go to the board members?
We could certainly consider some
like that
kind of minimum investment level or something like that.
Right, what we're doing, Wiley and I, with this, going through this experience, we're drafting a securities litigation policy, and so we'll be bringing that to the board, and that will give some parameters for everything on there, and then we can talk about if there's anything else that you would like to see in this policy, and that'll kind of give us a background of who can do what and when, and how things will work from that point.
Yeah, because I don't have, I doubt that if we had a situation come like this, that we're going to have a reason that we would, not approve what you all have approved already. So I'm not concerned about that.
Right.
I just didn't know if we needed to take some action to make sure we had a process in place. So.
I have a question, Mr. Chair. Actually, I have two questions. One of the questions is, what is our potential recovery? And I know that's kind of hard to know at this point. And the other is, what do we think the expenses will be, the legal expenses will be?
I don't have a feel for either of those answers to answer the question. Past experience, because it depends on how many people file claims. You could maybe 30, 40% at the most.
And what's our investment, our total investment?
Our investment loss on this one was approximately $130,000.
Okay. And we don't know at this point what our legal expenses will be.
Most of the legal expenses will be probably paid out of the settlement.
There was something there about 28%, wasn't it? 28%.
Right, they
The
would
law firm got a
receive
28%
of
recovery.
Right.
Right, they'll receive 28%.
Thank you.
And that includes most of their, if they have travel expense for some reason, but they have several clients they represent, so they'd have to split that with all of us.
And I may have missed that, but is that something that we could get, anytime we bring these forward, that we could get in there what our estimated loss is?
Right, it doesn't say the total on there, but yes, we can. It's on that last page that has the buys and sells. You kind of have to go through there, but they totaled
Okay.
that for it. But we'll get that for you more,
Okay.
a little bit better.
Yeah, if we just had it in the summary, that'd be good.
Yeah,
Okay.
it's kind of a new process for us.
Yeah, and I know this is new territory for all of us, so,
Right.
okay.
Now, isn't this a contingent fee?
Yes.
Yes, it's contingent fee.
We don't owe anything if they don't recover anything.
Exactly.
Right.
And if they do recover something, our share of the expenses comes out of the settlement.
Right. Yes,
So actually, it's a win-win for us.
right.
We're out nothing, and we may get something back.
We have a better chance of controlling the litigation this way.
So we're being asked to ratify.
Yes, sir.
Yes. And let you know, the court could decide that they don't want any other co-plaintiffs, that the main plaintiff is capable of handling the class. And in that case, this contract and everything will be ended.
We would get some information out of that.
Yeah, right, they'll let us know.
Right.
Right.
You would still be in the class.
Well, yeah, still be in the class. Right.
And that's just, that's the timing issue for the law firm. If there's other law firms that are going to ask to be lead plaintiff, they want to get there first so that they can be approved as the lead counsel for lead plaintiff.
Okay.
Seconded.
Okay, any further discussion? Okay, what is your recommendation? Approve, say aye. Any opposed, no. Hearing none, we will move on. Okay, we go to Roman numeral 4, which is approve the claims docket. 5, I'm sorry, excuse me. Roman numeral 5. Approve the claims docket.
Second.
For this, signify by saying aye. Aye. Okay, any opposed, same sign. Hearing none, that's approved. Number 6, approve the following applications for service retirement, 1, 2, 3. Okay, before this, signify by saying aye. Aye. Any opposed, same sign. Hearing none. Move to Roman numeral number 7, which is the report of death, and authorize the payment of the $5,000 death benefit. And we have 1, 2, 2. What is your pleasure? Okay, we're going to move in a second. Before this, signify by saying aye. Any opposed, same sign. Not hearing anything. We move to number 8, and this is also receive the report of death, authorize the payment, and authorize the secretary to make changes. We have 1, 2, 3, 4, 5 items. Okay, moving to second. What is your pleasure? Before this, signify by saying aye. Aye. Any opposed, same sign. Hearing none, we'll go to number 9, which is approve the following applications for vested rights. We have 1, 2, 3, 4, 5. Okay, before this, signify by saying aye. Any opposed, same sign. Hearing none. We go to Roman numeral 10, which is approve the request to terminate vested rights and commence during retirement benefits. We have 1, 2. Your pleasure? Okay, before this, signify by saying aye. Any opposed, same sign. Hearing none. We go to Jason, investment consultant report.
Good morning, everyone.
Good morning.
This morning I have the quarterly report for the period ending 9/30 and then the monthly update. I'll start in the quarterly report. If you would turn to page 8, I think I'd mentioned, we've been, at ACG, we've been working for a couple of years now on upgrading our reporting systems. What you're seeing probably is, well, that's a different font and different colors. But the investment that we've made in programming and technology and our ability to take in information seamlessly from custodian banks, but not just J.P. Morgan, but Northern Trust, State Street, Bank of New York, Mellon, as well as other vendors like MSCI, Russell, S&P, has really made our reporting system pretty seamless and robust. So we're just starting to see the output from that. So it's really the making of the sausage that has gotten a lot better in our view. And you'll see some upgrades, and I don't want you to just think it's the colors and the font on the page, but we think it's been a really good investment. So on page 8, just looking at overall capital markets, the middle column is the 1 year, and I'll tend to focus on that, but if you look at the left, you can see the quarter. Third quarter of the year was a pretty difficult quarter. Concerns over slowing growth in the China, Europe, as well as a lot of global situations going on in Ukraine and Ebola and other factors certainly having an impact on the markets during the quarter. That said, we've certainly seen a bounce back. The S&P hit another high, all-time high. Yes. Right. How does that affect markets? Yeah, I think, I don't think, it doesn't, it's completely reactionary. It affects investor mentality in the short term, and you see just confidence in whether it's consumers or investors just getting scared, and it's maybe thinking it's a good time to take some chips off the table. But it has no impact on fundamentals, as we've seen. One of the things that I think is worth pointing out, and you certainly see it within the portfolio, there is a huge dispersion between U.S. markets and other markets. If you look at the 1-year numbers, the S&P 500 up close to 20% for the year. Certainly the best performing asset class, large cap U.S. stocks. The U.S. economy seems to be doing well. Economic data looks good. Small cap stocks have sold off quite a bit throughout the year, but still up almost 4%, but that's a pretty big differential between large and small cap, the largest we've seen in some time. But if we look back over the last several years, small cap had done a little bit better than large cap. And then EAFE, or the MSCI EAFE, which is developed non-U.S., pretty meager returns, so up a little over 4.5% and negative year to date. And that's where we're seeing there's much slower growth expectations out of China, Japan, as well as Europe moving back into a recession, where the U.S. is talking about ending the QE programs. It's still going on in Europe, and things are a little bit more difficult there. From a fixed income standpoint, we did see rates back up a little bit, and the yield curve steepened. So yields on the short end of the curve have gone up a little, but long-term 10-year treasuries and longer came down a little bit, which was a positive for bonds. Intermediate to longer term, we still, our expectation is rates are going to go up. We're still at all-time lows for interest rates at some point. They're going to creep up, probably see a more flattening of the yield curve. The next, I'll just move all the way to, we had page 11. On page 11, we look at non-U.S. index returns, and the one thing I did want to point out, if you look at the 1-year column, that second bar, which is the MSCI EAFE, which is the international developed markets, you see it's up 11%. That's in local currency terms. one of the major impacts to the U.S. investors investing internationally has been the dollar. The dollar has appreciated pretty significantly relative to foreign currencies, and that's been a headwind. So the MSCI EAFE, which is the first line there, that's the return to U.S. investors in dollars, because when you're selling back those foreign investments and converting them into dollars, when the dollar has appreciated, you're taking a haircut. The last several years, really the last 10 years or more, it's the weaker dollar relative to foreign currencies has been a benefit to U.S. investors investing internationally.
Sorry. So if you look at the EAFE compared to the local currency, those two is really showing us that gap. Or
that's
that
showing you the
difference of
gap.
what
That
the
local
dollar's
currency is
doing.
what the actual return has been in those local markets if you just took the stock return and didn't convert it back into dollars.
I
so
see.
the EAFE is for a U.S. investor, once you convert it back into dollars, you've taken a 7% haircut. So when we look at international returns, a big part of that has been the currency.
Does that influence at all our decisions from an investment standpoint of where we are in those markets?
It's certainly the managers do take that into account. All of your Lazard, Harding Loevner, von Tobel, they are looking at that, and so they're not hedging currency out. Some investors may say we want to hedge out currency risk altogether, but that's also that diversification you're getting from the volatility in currencies is also a benefit. And
but everything that you report to us normally is just in the dollar.
It's in the dollar.
Converted,
it's in dollar terms.
So we see exactly
Correct.
what we get based on our value.
Yes.
Okay.
Yes. I was pointing that out so that to talk about the dollar has increased in value. And what that does, when the dollar increases in value, that pushes down energy prices, oil prices, because oil is priced in the dollar. So we've seen a pretty significant decline in oil prices. I think this morning it was under $80 a barrel. I've heard, there's a lot of interesting things that you're hearing about that, but to be able to purchase the average price of gas right now is under $3 in the U.S., and that's at that price, it's about a $60 billion savings to the U.S. consumer in what they're spending on gas. So thinking about other areas of the U.S. economy and why the U.S. is looking pretty good right now, that can be pretty bullish for consumer sentiment and the ability of consumer, which makes up 70% of the U.S. economy. So moving forward to page, I'll move all the way to your portfolio in tab 2, page 20. Looking at on a dollar basis, so for the calendar year, year to date, this would be the 9 months ending 9/30. You began that period at $632 million. Net additions, which is essentially cash flows, it's looking at money coming in, less money going out for payments, negative 14.3. You've earned on investments a little over $30 million. So at the end of September, the portfolio stood at $648.3 million. At the end of October, you were up another $10 million. So October was a good month. You can see for the quarter, however, the quarter was actually negative. There was a negative $6.4 million loss on investment during the quarter. Page 21, a little bit different layout here, but again, focusing on the 1 year. The return of the portfolio was 11% for the 1 year period ending 9/30. Relative to your policy index, which is the dark blue line there, which would be what your asset allocation would suggest, which is 10.4. So your managers and how you've implemented has added fairly significant value. And compared to other public funds with between 55 and 70% equity, you rank, and this is kind of hidden, this is a little different depiction than we've had before, but if you go down below, in the middle of the page, it says ranking, and you see those numbers from starting on the left under the 3 months, 47, 33, 25. That's the percentile ranking of your portfolio in that peer group. So for the 1 year period, you rank in the top 25 percentile of public funds with between 55 and 70% equity. It's a good, we look at this, I think more than anything, what's nice when you're up in the top, above the median, more than anything, it tells you a little bit more about your asset allocation, because we're not necessarily comparing apples to apples based on how other people implement. To be in the top quartile of funds with that high of an equity allocation, when you have 10% of your overall portfolio, which is more closer to about 17 or 18% of your equity in hedged equity, that's very good. You're really getting some outperformance from managers, which we'll see. 3 and 5 years, right at the median, but certainly on an absolute basis, well above your required return. The next page, and again, this doesn't line up with how you're measuring on an actuarial basis, but these are rolling 1-year periods. And what you can see, 4 out of the last 5 years, 4 out of the last 5 1-year periods, ending 9/30, you've gotten a return well above that 7.5% hurdle rate, which is really your primary objective, if you will. It's that 7.5. So this year, this 1-year period, 11.1. September of 2013, 12.4. September of 2012, 18%. So 2011, that was a more difficult year, and you're roughly flat. 2010, up 9.73. Page 23, we always talk about risk. So the returns, while the returns have been there, this portfolio is really structured to have much less risk than the markets. We would expect it to be down less when markets are down, and not quite up as much when markets are up. You have some protection in there. You're 100%, close to 100% funded. You want to maintain that. That is important, as opposed to constantly taking on risk to achieve greater returns. If you've got your house paid off, you don't necessarily have to put all your capital at risk as much as someone else who may need to make up a little bit more from their investment portfolio. And what you can see here in some of these risk statistics, the upper left is just a risk return chart going back to January of 2002, so about a 12-year period. About the same return, 3 basis points difference than the policy index, but with less risk. And those, it's pretty tight plotted there, but it's about 80 basis points less risk or volatility as measured by standard deviation. When we look at risk-adjusted returns, the Sharpe ratio of your portfolio is 0.59 relative to the asset allocation or the policy index of 0.55. So you're getting more return for less risk, which is what we'd like to see. A beta, which is a sensitivity measure, we want that to be under 1, sensitivity to the direction of the markets. And then the up and down capture, pretty consistent. As I said, what we would expect is that when the markets are up, you're not going to be up quite as much, but when the market or how you're allocated would indicate how you should do, when that's down, you've done better. So on the upside, you're capturing almost 95% of the upside. On the downside, you're only capturing 92.5% of the downside, so you're down a little bit less. If you turn to page 26, I'll just touch on a couple things, but then actually I'm going to refer to the ASAP because I think it's a little bit easier to see, to highlight some of these things, but I'll bounce back and forth. So the monthly report is through October. From an asset allocation standpoint, with the implementation, the addition of commodities, which were funded, let's see, the commodities was funded just October 1, so you have 1 month. It was the first month for the commodities allocation. But the overall allocation is much closer to targets now. Your equity is about 1% overweight, and there's a slight overweight to large cap, a little bit more of an overweight to small cap at 4%, and then long, short, private equity, international, and emerging are slightly underweight, but certainly well within ranges. And overall, like I said, your equity is really at the target. Fixed income is slightly over as well. Your real assets are much closer to that 15% now. We've been significantly underweight that as we've been moving toward funding those strategies, but now you're over 12%.
Question. If the small cap, mid cap being overweighted, in the way that their market value is falling? Were they a lot more overweighted?
No, because the large cap was more overweight. The funding for the commodities came out of large cap, and that brought that down, and it just, that 1 month snapshot changed the look a little bit. As we'll see, your small cap, while small cap has not done well, one of the things you've benefited from, which has looked like a headwind for some time, is the Earnest portfolio. Both Earnest and Times Square are SMID. Earnest strategy has drifted a bit more to mid-cap, and that's been a challenge for them when we're comparing them to the small and mid because they've been a little bit larger. But now, that's been a huge benefit to you. That Earnest portfolio, compared to you can see on the quarterly report, the year-to-date, they're up 4.3% relative to the policy index, which is up 0.97. On a one-year basis, they're up 14.4% roughly, and their policy is up 9.9. That ranks them in the 13th percentile relative to other SMID managers and the 3rd percentile relative to small managers. And that's because they're a little bit bigger, and the bigger names have done better. So that's been a positive.
Thank you.
So the second page of the monthly report, the ASAP, this just looks at composites and returns of the composites. So looking at from your asset allocation, what's helped and what's hurt. As we saw on the one-year basis, large cap stocks have done the best. Large cap stocks are with the exception of fixed income overall, large cap stocks are your biggest allocation in your portfolio. They're large cap U.S. is your largest allocation. It's a little bit overweight. On a one-year basis, your large cap composite, which is mostly indexed, you have the State Street Index, and then you have Intech, which is more of an enhanced index, if you will, up 16.8%. So that trailed the benchmark a little bit. Your large cap overall trailed the policy benchmark, but being overweight large cap relative to other things, that was a positive, but your managers trailed a little bit, but it wouldn't say that's significant. Over 3 years, about 20 basis points ahead in a allocation that's primarily indexed. We're not trying to generate a lot of excess return there, so you have very low fees. The small cap, on a one-year basis, the small cap added close to 200 basis points or 2% relative to the policy index, to the Russell 2500, 12.04 relative to 10.23, and that's the combination of Earnest and Times Square, both of which did very good value and growth. Long-short equity, K2 did well as a hedged equity relative to other hedged equity strategies. In the policy index, we're more concerned about the long-only benchmark, the S&P 500, from a risk standpoint. So from a return standpoint, in the year, the long-short was a drag. But over time, that's what's helping bring that volatility down. That's your insurance. Private equity, you've had a good year in your private equity portfolio. Really what we're looking at over a long period of time is a 200 to 300 basis point premium to public markets. Once that private equity portfolio really matures, you're still early on in this private equity program, but getting pretty good returns. A lot of that's come from the Sigler Guff distress strategy, which has had a lot of distributions back to you, but you've got a 16.25% return for the year. So that's pretty close to what the S&P did, and we wouldn't necessarily expect that to track along with public markets, but I think we have on the last page here.
Hey, Jason, can you remind me on the equities, that when we get the distribution back, how do we manage that? Does that just get reinvested according to our allocation? Do we hold that for other draws?
It depends on how it's being.
So it's just a matter of part of cash flow.
It comes back into cash,
Okay.
and if you need it,
Okay.
it might be used for benefits. So let's see, this month, in October, you had a $400,000 distribution, and you had a $75,000 capital call. So it might be, if they needed it for cash, instead of raising cash for managers, they could use that. If it's really large, it would be redeployed somewhere else. So we would look at your cash allocation and say, okay, we need to reallocate cash. But just to point out, that Sigler Guff fund, it's a 2009, you made a $5 million commitment. They've called $4.7 million and distributed back to you 4.4 million, and there's still 2.7 million of value. So you've got almost all of your money back, and there's still over 2.7 million in value. So it's a 1.5 times your money in about 5 years so far. So that's doing very, very well. Just as we move down further here, the international portfolio, while international has not done great, your managers have done well. This is Lazard and Harding Loevner. A lot of it's been more recently as markets have gone negative. Harding Loevner has protected a bit, and they've done good and a bad. They haven't done as poorly as the market. So that's been additive on a relative basis. So your international equity is up 4% roughly over the last year when the index is negative 0.19. So your managers are doing a nice job. Emerging markets, this was an area last year where we were looking at these two managers, Von Tobel and Wasatch, and the timing didn't look great, but now you're seeing what we would expect. Von Tobel in particular, this is very high quality, really focused on the consumer in emerging markets. They've done very well. Their one-year return through September was 9.6% relative to the benchmark of 4.6, ranking them in the top 20%. Wasatch, you may recall, they are an emerging market small cap manager. They're going to be your most volatile manager in your portfolio. When markets are really running, we would expect very superior returns from them. In a more difficult environment like we've had, they'll struggle a little bit. That's why it's such a small allocation. You have roughly a 2% target there. More recently, they've started to do okay, up 5.5% on a 1 year through 9/30. Trails the benchmark, but it's actually in line with peers. It's about where peers have done. But overall, that emerging market portfolio has added about 5% relative to the benchmark. And the fixed income overall up almost 5%, surprising when yields on 10-year treasuries are close to 2%, kind of between 2.5% and 2%. Your fixed income portfolio is up close to 5% for the year. A lot of that coming from the diversification that you've had. The Western Core Plus portfolio certainly doing well. That's primarily credit, corporate credit, U.S. corporate investment grade credit, some non-investment grade or high yield. That portfolio is up 5.5% through October relative to the ag, which is up 4.1%, so very additive. The PAMCO, PAMCO was not here last month, it was K2, but the PAMCO portfolio on a 1 year basis up 2%. You've got there's some very low volatility or market neutral equity in there, which has been a bit of a drag, but longer term that's done well. And then the real positive factor you get back to currency, the Brandywine strategy is a global bond strategy, so it's not just diversifying currency exposure, but it's diversifying interest rate exposure too. They're looking at for relative value where they can get higher yields in certain markets outside of the U.S. And you see there on the page 3, their return over the 1 year period is almost 6.8% relative to the ag, which is 4.1, and relative to the world government bond index, which is actually negative. So that diversification in your fixed income has really helped. And then finally, the real estate portfolio doing fairly well. The Morgan Stanley Prime Property Fund up 13% through September. That's the latest data that we have, outperforming the Odyssey, which is up 11.3. And then your private real estate, that's actually adding some as well. The TA Associates up 11.5%. This is, again, much like your private equity. We wouldn't expect to see these kind of returns this early on in this portfolio, but you are getting them, and it's doing positive. I've gone through in a little bit more detail. I just wanted to point out we're usually talking very high level, but at the high level asset allocation level, the allocation has been additive, but all of your managers are doing very well right now. We don't expect that to be 100% of the time. We know things ebb and flow, but that's why you have patience over time. Things come in and out of favor, and not making a lot of changes and churning things is certainly a positive in the portfolio. Any questions on the
Questions, anyone? Thank you, Jason.
Okay, thank you.
Do we need to move to have that accepted? Okay. Comments from board staff, citizens?
I have a comment. I met with a group of retirees yesterday who expressed concern about the lump sum distribution available to some retirees who have less than 25 years of service, less than normal retirement. They were concerned, their particular concern was the impact that those future distributions could have on the retirement system. They specifically mentioned the reduction in the maximum cost of living from 4% to 2%, and so they asked that I bring that to this body and we consider looking at that policy in terms of the $30,000 lump sum distribution. Only for those that have less than 25 years of service.
Were they asking for a report back, or were they asking for a change in the policy?
They're asking that the trustees consider changing the policy, so we might want to just take a look at that.
And they just wanted us to take a look at how we might change it, like if it'd be a lower lump sum, or if there'd be no lump sum?
Yes, that's exactly what they're wanting us to look at. Make that lump sum distribution only available to those that have.
So eliminated is what they would prefer.
Eliminating is what they would prefer, but they would probably like something less than maybe the $30,000. They're concerned. They are aware of what's happening nationwide with some pension systems, and they are aware that we've made some changes to sustain this pension system, and that's just one of the features that they brought up yesterday while we were meeting.
Renee?
Right, and right now the ordinance provides normal retirement. Normal retirement is defined as 25 years of service or age 65 with 5 years of service. So the way we define normal retirement, that allows people that are under 25 years to also receive the option to have the partial lump sum if they are of age 65 and have at least 5 years of service when they retire also. Of course, the partial lump sum payment is a reduction in their future benefits, so it is actuarially neutral is the way it is designed, so there is truly no impact except for cash flow. It is just normally the system actually gains money because most people seem to outlive a lot of times will outlive the actuarial content of how we design the plan to only charge so much for it, and then you pay it back over the course of the lifetime of your benefits.
That was explained to the group yesterday. They were pretty adamant. So what might help is if I put this particular individual in contact with you.
We can do that, and we can also look at, we could drop the $5,000 lump sum death benefit also if we're worried about cash flow, if the retirees, because we pay out just as much of that at $5,000 a time as the $30,000 over how many people actually take that also.
So what if Renee met with that group, and if they still wanted us to look at it, then we could refer it to the Plan Design Committee?
I think that's a great idea.
Because I think that didn't the actuary look at that for us and give us a report? Mm-hmm. And were we able at that time to say that it is, in fact, because she said that it's designed, if you take all the actuarial assumptions into place, it's designed to be cost neutral.
Right.
And it seemed like there was one question that was asked that I don't recall that we got a clear answer on, as to whether or not our actual experience has been that way.
Right, unless you actually go through each individual person, you're not going to know, because some people are going to be, depending on how long they live, if they live shorter than their life expectancy, then they may not have paid as much as they've got out. Now, they live longer than their life expectancy, they're paying more for it than what they actually got. So in reality, when you take the whole fund together based upon our life expectancy tables, then it's deemed to be actually neutral. That's the way they design it, not on a per-person basis. So unless we could go back and say, employee X, yes, employee Y, no. But overall, the plan has right now, when we redesign the mortality tables, all of that was taken into consideration, so it was still actuarially neutral at that point.
Okay. And when you talk to them, too, you might take, the statistics of how many people actually take that.
Right.
Might be helpful as well, to really
Okay.
know that when you look at the grand scheme, that
It's a
this is
small
not going to move
percentage,
a
right.
lot within the plan.
Right.
But I can understand their concerns of, if they're having to lower the cap, if we lowered the cap on what we provide for cost of living, that they want to make sure we're not giving up ground in other places. So it's understandable, but I think having those statistics would be helpful.
Okay.
Renee, just out of curiosity, do you know the percentage that actually take that 65 and 5 years?
If I just look at the 65 and 5, no, I'd have to go back and just pull those individual people out. Now, I know overall, it's less than 50% of the participants tend to take it. A lot of times at the beginning of the year, a lot of people seem to take it in the first quarter of the year. The last half of the year, less participants seem to take it only because of the tax problems that it can create.
I also have had these people approach me the past couple of years, and at that time, our funding was somewhat less than it is at the present time, and then when we had 101% funding, I assured them that the actuarial study showed that the board had been following sound advice, and that really this was a benefit to some that want to exercise it, and it was not penalizing the other members of the board. So they switched from contacting me to contacting others.
Right, I mean, it's
Clarify that. That's not necessarily true. We were meeting on a totally separate issue, and after the meeting concluded is when this was actually brought up. So they didn't contact me for the specific purpose of discussing this. We were discussing a totally unrelated issue.
right. I mean, this provision was designed for the actual cost of receiving that benefit is paid by the person that elects it.
I've tried to explain that, but again, you look at the 30,000 coming out, and I've tried to explain to them the real beneficiary, the 30,000 coming out, is the Internal Revenue Service and the Oklahoma Tax Commission, because the taxes come first, and it's a substantial amount.
Right. The
Rather
person
than-
only usually receives about half of the 30,000 if they
Right.
decide to take it, by the rest is paid in penalties and taxes.
Okay,
Again,
so
I've
where have we
counseled
left
it.
this? Are you going to talk to that group again? Renee's going to talk to that group
Right.
again, and then we'll decide
We'll
after
move
you
forward,
visit
yes.
with them the next step.
Correct.
If any,
Yes.
okay?
Renee, doesn't the payout result in the plan realizing less investment risk too? Because we paid that money out, now we don't have to have that, and if we reduce their benefits based on a 7% assumed rate of return, so now we don't have to make that 7% over that period of time, right?
Well,
So,
it's kind of a, right, but then you can't make 12% on it either. I mean,
Right.
you're, right, I mean, it's kind of, you're,
But in terms of losing,
right, we're not really losing anything on it. It's
Right.
just cash flow
So we
that
have-
is the
Yeah.
issue. I mean,
But-
you don't have it to invest, but then you also don't have the liability attached to it because their benefit has been reduced, that you need to pay for in the future.
Any other questions? Okay, thank you, Renee. Any other comments? Well, thank you, Wiley, Renee, Jason, for your presentation, and it is 10:43, and we stand adjourned.